We are diving straight into the Q3 2025 results for Williams-Sonoma Inc.,
Right.
WSM.
Yeah.
And we have to, because there's this classic contradiction playing out. A massive earnings beat, they raised their guidance, and yet the stock, it dipped sharply.
That's the paradox, isn't it? It's the core of what we need to figure out today. You've got what looks like, flawless operational execution.
Oh, that's the word.
They beat on EPS, beat on revenue, raised the profit outlook for the whole year,
Right.
and the market just refused to reward them for it.
So we have to unpack that.
Right.
What fears are investors weighing against this incredible performance?
Exactly.
Okay, let's get the hard facts out there first. Give us the scoreboard on Q3.
The financials were, undeniably strong. WSM reported earnings per share of $1.96.
$1.96, and that blew past the forecast of what, $1.87?
Right. It's a 4.81% surprise in the bottom line. And revenue was strong too, $1.88 billion, just a bit over the $1.86 billion expected.
So beating on both earnings and revenue. For a home goods retailer in this economy, that's huge. So what explains the dip? The stock dropped 3.18% right after the news.
Well, when you see that kind of thing, a great report and a bad stock reaction, it usually means the market is pricing in risk that, isn't solved yet.
Macro stuff.
Macro stuff, exactly. Or just reacting to volatility. WSM stock has a beta of 1.54.
That's high.
It's very high, so it's way more volatile than the market as a whole. Any hint of pain, like inflation fears or that housing slump, it just hits WSM harder.
That makes sense for the knee-jerk reaction. But management, they clearly feel pretty confident because they updated their forward guidance.
Yeah.
What did they signal there?
They signaled real strength. First, they reiterated the full-year comp revenue growth, still positive 2% to 5%.
Okay.
But the crucial move, the really big one, was raising the full-year operating margin guidance by 40 basis points.
Let's pause on that. 40 basis points. For everyone listening, that's nearly half a percentage point improvement. With all these headwinds, why is it such a massive vote of confidence?
Because it shows they have incredible internal control over their costs. They are raising the floor on their own profitability. The new range is 17.8% to 18.1%.
Wow.
To keep margins that high while absorbing these huge supply chain shocks, it just tells you their operational playbook is working.
So they're not just reacting, they're actually executing a plan.
A structural improvement plan, yes.
And that's what we need to unpack. How in the world did they deliver a 17.0% operating margin in Q3?
Right.
Expanding it by 10 basis points when their own CEO called it the worst housing market in 40 years.
It's all about controlling what they can control. It starts with their gross margin, which improved by 70 basis points to an impressive 46.1%.
Okay, where did that come from?
Two places. 60 basis points of that came from higher merchandise margins. So they're selling more stuff at or near full price.
Plus discounting.
Much less. And the other 30 basis points came from genuine supply chain efficiencies. They're just running a much tighter ship, logistically.
Okay, but speaking of shocks, the biggest one has to be tariffs. And that's probably what spooked investors. Management said the rate has more than doubled from 14% to 29% today.
It's a massive headwind.
So what's the defense strategy?
They laid out a pretty comprehensive 6-point plan, but you can really boil it down to a sort of 3-pronged attack.
A 3-pronged attack. I like that. Let's break it down.
Okay, so first is external negotiation. They're going to their vendors and getting deep cost concessions, just pushing back.
Using their scale.
Exactly. The second is internal optimization. So finding more supply chain efficiencies, controlling costs, reducing SG&A.
So standard corporate cost cutting? But what's the third pillar? You said it was more strategic.
It is. The third pillar is a strategic sourcing pivot. This is the long-term play. They're actively moving production to lower tariff countries. And crucially, they're expanding their made in the USA assortment.
So bringing it closer to home.
Right. It's not just about tariffs. That gives them better quality control, faster speed to market. It's a huge competitive advantage.
But I have to ask, when you demand massive concessions from vendors, is that sustainable? Are vendors pushing back at all?
That is the right question. The transcript doesn't really detail any pushback, but the fact that they expanded merchandise margins so much tells you it's working right now.
They have the leverage.
They have the leverage. WSM is a partner people want to have, so they can demand better terms and, basically transfer some of that tariff burden up the supply chain.
So if they're so good at mitigating this, why did they specifically warn the market about Q4?
This is all about timing. And this is why investors got nervous. Management said the full impact of those higher tariffs is taking longer to flow through than they thought.
Why is that?
Well, partly delayed effective dates, but also because WSM was smart and front-loaded a bunch of inventory at the lower tariff rates. So they expect the tariffs to have a substantially larger impact on margins in the holiday quarter, in Q4.
So the pain is coming.
The market knows the pain is coming, even if the guidance was raised to account for it.
Okay, so they have a plan, but there's still difficulty ahead. And despite all that, they still managed a 4% comp sales increase. Where is the growth coming from?
Well, the amazing story here is that every single one of their brands reported positive comps.
Every single one.
Every single one. That is so rare right now. But the real star was the core Williams-Sonoma brand. It delivered a spectacular 7.3% comp sales increase.
7.3%, that's a huge number. If the housing market is dead, what on earth is fueling that?
They're leaning into what you could call the home experience economy. They aren't just selling pots and pans, they're selling culinary authority. Experiences, exactly. This quarter was all about culinary stories, like collaborations focused on authentic Indian or Spanish cuisine. That drives sales of high-margin accessories and tools, not just big-ticket furniture.
And the book signings. They mentioned 42 in-store book signings with celebrity chefs. That's a huge commitment to getting people in the door.
It is, and those events are incredible traffic drivers. When you get a motivated customer in the store for an experience, they walk out with something. It insulates them from the softness in furniture.
So how does that compare to the other brands like West Elm or Pottery Barn?
It's a tale of two strategies. West Elm had a strong 3.3% comp, mostly because they fixed their inventory issues. And Pottery Barn was up a much more modest 1.3%.
That gap is really telling, isn't it? 7.3% for the flagship versus 1.3% for Pottery Barn.
Because Pottery Barn is just more exposed to that housing market. People put off buying a new sofa when interest rates are this high. Its growth really came from reducing promotions, which is good discipline, but WSM's growth came from traffic and experience.
It really shows the genius of having that diversified portfolio.
It does. When furniture slows, culinary carries the weight.
And this all reinforces their digital-first, not digital-only model. How did the physical stores do compared to e-commerce?
The physical store was a powerhouse. The retail channel ran a positive 8.5% comp. Yeah, driven by these new remodeled stores and better in-store design services. E-commerce was also positive, up 1.9%, and still makes up a massive 66% of their total revenue.
Okay, beyond the core brands, what about the white space opportunities? I heard the CEO made a bold claim.
A very bold claim. It was about rejuvenation, which had double-digit comps. The CEO called it their next billion-dollar brand.
A billion-dollar brand. What's behind that?
It's all about its positioning. Rejuvenation is high-end, heritage lighting and hardware. That market segment is way less price-sensitive. It's for affluent buyers who are still upgrading their homes even if they aren't moving.
So they're targeting customers insulated from the macro environment. What about their other growth engine, B2B?
B2B is a sleeper hit. It grew 9% this quarter. And this isn't just office desks. They're winning big commercial contracts with companies like Google and PayPal.
That's a whole different revenue stream.
Completely separate from the consumer cycle. And they're even testing new concepts like Green Row, which they're so bullish on they're planning to test physical stores for it.
Let's switch to efficiency. AI was mentioned over and over again. We hear a lot of noise about AI on earnings calls. What is WSM actually doing with it?
They're using it aggressively for two things: SG&A leverage and customer engagement. On the cost side, their AI-powered chat is now resolving over 60% of chats without any human help.
60%. That is a staggering number for the bottom line. But what about customer experience? I mean, WSM's premium brand? Is there a danger you alienate shoppers by automating service?
That's the strategic tightrope they're walking. Management says the AI handles the routine stuff, which frees up the human teams to focus on the high-value, complex conversations.
I see.
And look at the results. They've cut the average handle time for a chat from 23 minutes down to just 5. So if you can solve routine problems faster, customer satisfaction actually goes up while your labor costs plummet. It's a pure margin driver.
And what about using AI to actually drive sales?
That's the other side of it. They launched Olive, an AI culinary companion for the Williams-Sonoma brand. It uses all their proprietary recipes and content to help you plan meals, learn techniques, and then...
It builds the shopping list for you.
Exactly. It builds the shopping list and drives you right to their digital store. It's incredibly sticky.
Okay, let's wrap up with capital allocation. They have a fortress balance sheet. How are they rewarding shareholders?
It is a fortress. They've got $885 million in cash and 0 outstanding debt. So in Q3 alone, they returned $347 million to shareholders through dividends and aggressive stock buybacks.
And the board just doubled down on that commitment.
They did. They approved an additional $1 billion stock repurchase authorization. I mean, that's management basically screaming that they think their own stock is undervalued.
Right.
And, 2025 marks the 16th consecutive year they've increased their dividend. That signals reliability even in this chaos.
So this deep dive really shows a company with just robust operational control. They're boosting margins, mitigating tariffs, using AI for real efficiency, and driving growth in the worst housing market in decades.
And if that housing market ever does turn around, they believe they are uniquely prepared to capitalize on it. Their supply chain is better, their retail footprint is optimized, they're ready to capture that demand the second it appears.
So what does all this mean for you? Williams-Sonoma beat earnings, they raise their guidance, but the market got spooked by external volatility and that coming Q4 tariff hit. So the provocative thought to leave you with is this. Which factor holds more weight for their future? The incredible strength of their internal operational model and their AI adoption, or the continued, lingering uncertainty of the tariff landscape in the housing market? Something to mull over as you watch the next quarter unfold.